Friday, November 2nd, 2018. The first Friday of every month of my working life, the Bureau of Labor Statistics has released the change in payrolls and wages from the prior month. It's more important than anything. It's more important than every other datum during the month, especially to the bond market and the Fed. Inflation is linked sooner or later to jobs, job growth, and wages. And today we got an unusually large number, but everybody I know in the marketplace, the phone calls have been running all day long trying to figure out what really is up. We've just gone through a month in which the stock market corrected a full 10% and is probably not stable. Even it went down 10% and has retraced halfway, but is probably not stable. What everybody I know is looking for, that is the professionals, the bond market types, are trying to look around the corner, over the hill. I get all of this, what the Fed's doing and why, but what's next? And they're the first signs that maybe the national economy is slowing down. And typically it doesn't slow down gradually, it just slows down all of a sudden. Every recession on record, everybody in markets and outside has discovered in retrospect. The National Bureau of Economic Research announces inevitably that, jeepers, a recession started last summer or whenever. As it stands on the surface, the Fed is going to continue to raise the overnight cost of money from the 2.25 where it is now up to 3 or more next year, and an argument about a pause next year. But it would be just like the economy to fox us and begin to slip for some other reasons. What might those be? We had a huge fiscal stimulus this year, an increase in federal spending. Classic sugar high. We feel that stimulus when it takes place and we don't feel it afterwards. It has no half-life. It has no duration that continues to stimulate the economy. We know pretty conclusively by now that the tax bill was a bust. It gave a tremendous amount of money to people who already had a tremendous amount of money, but it's done nothing for consumer spending, maybe nothing for net consumer income. It's produced no tax revenue, even though the economy is about as hot as it gets, and it's produced no wave of investments, which would be longer-term stimulus for the economy. So rates rose in October from a band that we had been in between 290 and 310, the 10-year Treasury note, which was mortgages just below about 4.75. Exactly a month ago we popped out of that and we came up to the 10-year T-note between 310 and 320, mortgages 5 1/8 or so. The Fed started to tighten 3 years ago. There is some ancient math involving how much mortgage rates need to go up in order to slow housing and slow the economy. That ancient math is 2 percentage points. Dead rock bottom, twice in the prior decade, was 3.5, and we're now above 5. I want nothing bad to happen to the economy, but I also don't want interest rates to go up more. And I don't want to see a painful recession take place, but there is a growing chance, these are always odds, there's a growing chance that the economy is slowing down enough in a combination of the Fed, higher interest rates, slowing housing market, just enough that we're through this episode, or most of the way through it. So I wouldn't be misled by the strong job number today and the threat that the Fed has to go higher and harder. I think most of that may be past us. So turn an economic slowdown into good news, and that may be what we have right now. Good weekend.